So what we found is that firms in the US are generally more entrepreneurial than they are elsewhere. And that's especially the case within technology, where we've found that companies in the US have really been at the forefront of technology. And as a consequence of that, they've really been able to develop these network businesses that have grown very fast by using intellectual property, and that's led to very high returns on capital employed. In addition, for all firms in the US, they have a large single market with no barriers between the market, and so that allows them to grow relatively quickly to quite a large size. The US also has low tax rates, they're quite deregulated, so all of these factors lead to the US generally, and companies in the US having higher returns on capital employed than elsewhere. Now, the downside of that is it's well recognized, and so valuations in the US tend to be a lot higher than they are elsewhere.
So we invest globally. We look at non-US firms and US firms. We have some really good non-US firms in our portfolio. But the US firms do have some advantages. So first of all, they have the benefit of a very large home market. It's typically lightly regulated, has good demographics, faster economic growth. That market is often very profitable and it can fund their overseas expansion. Secondly, in terms of management, they have generally very highly incentivized management. They often look like they are being overpaid, but they have good alignment with shareholders. They're ambitious, they use technology very well, and generally they are winners in their markets.
I think that's a very complex question and depends on which part we're looking at. So the easy part is tax cuts and deregulation, which generally are very positive for corporates that earn in that jurisdiction. So it'll be good for US corporates if we see tax cuts and fewer regulations. On the other side, the reindustrialization is a lot more nuanced because supply chains are very well established around the world, and so bringing back manufacturing to the US may not be entirely positive. It depends how it's done. If it's done with tariffs, that may well be inflationary. And also, if they reindustrialize things where it's just more efficient to make them elsewhere, that's also likely to be inefficient and inflationary. So overall, it's a complex picture, and we don't quite know yet how it's going to play out.
Well, a lot of the subsidies that Biden put in place, the CHIPS Act, are actually driving some reindustrialization into the US in certain industries. Trump's tariff policy may drive more, but the issue with that will be, first of all, on some industries it won't have any impact at all. For example, footwear, only 1% of shoes are made in the US, 99% are imported. It seems very difficult to imagine that Nike is going to start building factories all over the US because there have been some tariffs put on. One of the issues is that nobody will know how long those tariffs are going to be there for. Trump could change them tomorrow, another president could change them in 4 years' time. So it's quite difficult to predict what kind of reindustrialization there will be as a result of tariffs. Deregulation is generally considered to be a good thing for businesses. It makes it easier to do business. The problem will be if he regulates too lightly and there's a consumer backlash against particularly the tech platforms. In 4 years' time, another president will then put a lot of pressure on to re-regulate. So on tax cuts, in the first term there were some big corporate tax cuts which lifted the value of businesses, but now you'd have to ask the question how sustainable future tax cuts would be given the US budget deficit.
I think it's a little too simplistic just to look at the valuations as a whole of the US versus the rest of the world. It's certainly the case that on a headline basis, most multiples are elevated in the US, so price earnings, free cash flow yields, etc. They look very high and stretched relative to the rest of the world if you look on an aggregate level. However, it's pretty clear to us that there are pockets of value within the US. So high growth companies look very expensive, but at the same time, companies that are growing more moderately around GDP kind of levels, they appear to be largely ignored by US investors, and so the valuations there are looking appealing in some cases.
There's a big divide in the market. The very largest companies generally look quite overvalued. The top 10 trading on multiples of 30 times. That looks like a technology bias. But the 8th largest company, Berkshire Hathaway, is also highly valued, and that's an old style company. On our own watch list, we've got 200 companies. These are companies that have passed our quality tests, and we look to see when they fall into value territory. Some of them are still overvalued, but some of them are now falling into value territory, and they're getting interesting to invest in. We're only looking for 20 high-quality, undervalued stocks. So in general, the whole market isn't the issue for us. It's whether we can find the few good companies that are undervalued.
High market concentration will almost definitely lead to greater volatility, both of the index and of active managers' performance against that index. So we should expect to see greater outperformance and greater underperformance of a more volatile index by active managers, especially if they're not quasi-index huggers. What is clear is that over the long term, the equally weighted index has hugely outperformed the market-weighted index. And the reason for that is in the equally weighted index, smaller companies that tend to be faster growing have a greater weight than in the market weighted index. Now, if we see that return to equally weighted index outperforming the market weighted index, we should really expect active managers to perform very well, certainly relative to the market weighted index.
I think high market concentration is a concern. The top 10 stocks in the index, in the S&P 500, now represent 35% of the total market cap of the index. That's a higher level than we've seen before, much higher than in the dot-com era. Also, a number of those stocks are in a similar kind of business. The tech giants, the Mag 7, their share prices are all lifted up by the promise of AI, and they're investing significantly on that. 330 billion this year, which is double what they were spending 2 years ago. So if that money is not being well spent, the impact on the share prices would be very negative potentially. So anything that pricks the AI bubble, if it is a bubble, could have a big impact on the share prices of those companies and of course then of the whole market.